Now, let's see how can we apply the 5 steps model on this example. First of all, the step number 1 is addressing the contract itself. So actually, in this case, we have a contract and a contractual agreement between the company and the customer. The company agreed to deliver something to the customer, which is 100 units, and the customer agreed to pay to the company as of today the $10,000, which is the purchase value of these 100 units. So there is a contractual agreement, and the right for each party is clearly specified, and everyone knows what he is going to deliver to the other party. And the payment terms is also clearly specified, which is cash on spot as of today. So the contract, all of the conditions are already available, and it is a contract under IFRS 15. The second step is to determine the performance obligations. The performance obligation in this case, it is at the 100 units, the delivery of the 100 units of the product. And these units is identical, so it's a series of identical units within the same performance obligations. And all of the 100 units will be delivered on the same day. So the performance obligations is the 100 units that to be delivered, and it's already delivered in the business case. Step number 3 is related to the transaction price. Both parties agreed that the transaction price is $10,000. But the question here is, if this $10,000 is a fixed price or a variable price? Let's understand the right of return that's included in the contract. The right of return gives the customer the right to return any unit of these 100 units during the contract, during the return period, which is 30 days, to the company, and then the company is going to refund the customer for any returned units. So the final transaction price, it's not fixed. It is variable based on the number of units the customer is going to return to the company. So I cannot say that 10,000 is a fixed transaction price, because actually the company can return any units, so can return or can refund any value of this $10,000 to the customer when the customer return units to the company. So again, the transaction price is not fixed because it will be depending on how many number of units the customer is going to return to the company. So the transaction price here is a variable transaction price, a variable consideration. So this is step number 3. Step number 4 is to allocate the transaction price over the performance obligation. We have only one performance obligation, and this is the value of this one performance obligation. Step number 5 is related to the recognition of the revenue. The question here is when and how much. When the company should recognize revenue and on how much value. This is the two main questions that we are going to answer today in this example. Let's start by the accounting entries. In the first day, when the company is going to deliver the 100 units and the customer is going to pay $10,000. The question here is, how much cash did we receive? We received $10,000. So we are going to make debit on the cash $10,000. Cash $10,000. This is the amount that we received today. Now come to the credit. Shall we recognize revenue today? Yes, we have to recognize revenue today because you transfer the control of the units to the customer. So you need to recognize the revenue today, because step number 5 is stating that you need to recognize revenue whenever you transfer control to the customer. And as long as the company transfer the control of the 100 units today to the customer, so the company should recognize revenue today. But on how much? The company should recognize revenue based on the amount that the company is expecting to be final revenue from this transaction. The amount that the company is not expected to be reversed. I can recognize revenue today for the full 100 units, but later on the customer can return something. So this can be reversed later on. I have to recognize revenue today as of the net. The net, I believe that it will be the net transaction price after the returned units. Shall I wait until the customer return the units? Actually, the answer is no. You have to consider revenue today. So what the solution here? You have to build the estimate on the returned units. Based on the statistical data analysis that we did for the company history, we discovered that 3% of the units will be returned during the return period, which is 30 days. So I have to recognize the revenue as of today on the 97%, because 3% will be returned. So 97 I'm expecting will not be returned. So I have to recognize revenue today on these 97 units. Okay, so let's start recognizing revenue. So revenue will be recognized for the 97. So 97 units times the unit selling price is $100. So the total revenue value that I'm going to recognize today will be 9,700. Now there is something missing in this entry. I received cash 10,000 and I recognize revenue 9,700. So there is a $300 missing. Yeah, this is related to the 3 units that I'm expecting to be returned. Let's understand. You receive cash $300 today, part of the 10,000, and you are expecting to return this cash again to the customer when the customer is going to return these 3 units to you. So the cash that I receive today, I will consider it as a refund liability, because I received cash and I'm going to return it again to the customer. I'm going to refund the customer again once the customer returns these 3 units. So I'm going to consider today a refund liability in the first day of the transaction, because I received cash that will be refunded later on to the customer if the customer returns these units to me. So the entry here, to continue the entry, we are going to say refund liability, and this sorry, there's a misspelling, liability, and this will be with a value of 300 as a liability in the credit. Now I finished the first entry related to the revenue. There is one more entry you have to recognize in the first day of the transaction, because you recognized revenue. So you have to recognize the cost matching of this revenue, which is the cost of goods sold. Now let's go here and start determining the entry of the cost of goods sold. Cost of goods sold, how much units you recognize the revenue for? I recognize the revenue for 97 units here, 97 units. So you need to recognize cost of goods sold based on the 97 as well. So I'm going to recognize revenue, I'm going to recognize revenue 97 times the cost per unit, which is $60. So the cost of goods sold in this entry will be divided by 5,820. This is the total amount of the cost of goods sold that are matching the same revenue that you recorded in the first entry. So you recorded revenue 97 units, and you recorded in the cost of goods sold cost for 97 units as well. So both revenue and cost are matching in this case. There is no difference. But come to the tricky here. The tricky point here, that you issued from your inventory how many units? I issued 100 units and I give it to the customer. So you need to recognize reduction in the inventory by 100 units. The reduction in the inventory will be in the credit. So let's here record the inventory. How much is the credit in the inventory? The reduction of the inventory, the units that I issued. So it will be 100 units times the cost, because actually the inventory is valued at the cost. So you need to recognize it based on the cost. So you are going to record credit in the inventory by 6,000. Again, the question here is the entry is not balanced. There is something missing. You issued the inventory 100 units and you recognize cost of goods sold for 97. So there is still some units are missing, which is 3 units are missing in this entry. So you are going to recognize in the debit side 3. Why? Because you delivered 100 units to the customer, and you are expecting the customer will return back again 3 units. So this is an asset that I'm expecting to receive from today. So I'm going to say here expected returned units from customers. How much is it? Actually, I'm expecting 3 units. 3 units. Okay, 3 units will be I'm expecting to receive from the customers based on the COGS, on the cost of each unit. How much is the cost? It's 60. So now you are going to debit this asset, and this will be one of the assets that you are going to recognize in your balance sheet. This is a newly identified asset that you have to create an account for in the GL or in the GL for in your accounts, in the chart of accounts in your accounts. So you need to recognize 180 today as a debit value in these assets, and this will be one of the current assets that you are going to recognize in the balance sheet. as a result of applying IFRS 15. Okay, now let's see the entry. The total of the debit side now is 6,000 and the credit side is 6,000, so the entry is balanced. Now let's continue the scenario. After the 30 days finished, you discover that the customer returned only to you 2 units, not 3. So now let's see what will be the accounting entries here. We have to answer several questions. We recorded the refund liability. So what will be the impact on the refund liability today? You recognized revenue for 97 and the customer returned only 2 units for you. So do we have an impact on the revenue? You also recorded an asset which is the expected returned units from the customers, which is 3 units, but the customer returned only 2 units. So do you think that these 3 accounts will be impacted by that? Also for the cost of goods sold, you recognize cost of goods sold for 97 units, assuming that 3 units will be returned, but only the customer returned 2 units. So all of these accounts, we have to readjust the calculations and the accounting for based on the facts that we have today, that 2 units have been returned. And this is the meaning of the estimates in accounting. In the first day of the transaction, we estimated 3 units to be returned. The IFRS is stating a general rule. Any estimate must be reviewed periodically. So here in this month, the estimate that we estimate, the assumption that we set that 3 units will be returned, now we have a fact that only 2 units have been returned. So we have to review the accounting. Let's see here what we are going to do in the first entry. Number 1, the refund liability that we recorded here for 3 units at the $300 because we recorded at based on the selling price. Now the customer returned only 2 units, so we have to debit the refund liability. So we are going to debit the refund liability. By how much? We are going to debit it by the number of units that the customer returned already. So we are going to multiply 2 units times the $100 per unit, which is the selling price per 1 unit. So now because I received 2 units, so I'm going to reduce my refund liability. And you have to repay the customer cash. So the cash will be credit. So I will have to repay the customer or refund the customer cash for the same value, which is 200. So now this is the first part of the entry that we are going to do. That I have to repay the customer, refund the customer, the cash against these 2 units and reduce the refund liability. This is the first part. What else? You need to recognize that your inventory had been increased by the 2 units that you received from the customer. So I am going to say, okay, my inventory will increase by 2 units because I received 2 units from the customer. Remember, you issued 100 units from your inventory here. You issued 100 units from your inventory. So now you need to increase it again because you received 2 units from the customer. So I'm going to record in the debit side 2 units times the cost of the unit, which is $60. So I increased the inventory by $120 today. And at the same time, you recorded an asset which is expected returned units from the customer. Okay, there is a misspelling here. So you expected returned units from the customer, you recorded asset 180. So you need to recognize reduction from this asset because you received 2 units. So I am going to say this is the expected returned units. I'm going to say that I received 2 units. So I'm going to reduce this asset by the same value, which is the 120. So now this is the second part of the entry. I received 2 units. I reduce the asset that I'm receiving. Okay. Now come to the 1 unit that the customer didn't return. I was expecting the customer will return 3 units. The customer, and I recognized revenue on 97, but didn't recognize revenue on the 3 units. What happened in the actual, that the customer returned only 2 units. So he didn't return 1 unit. So this 1 unit that I didn't recognize revenue before, I have to recognize the revenue on this 1 unit today. So I am going to recognize revenue today. So you are going to say, in the credit, I am going to recognize revenue. But what about in the debit side? In the debit side, you recognized refund liability initially how much? 300. Then you debited 200. So the remaining balance in the refund liability is $100. So you need to recognize debit in the refund liability debit in the refund liability by 1 unit times the selling price, which is 100, and you are going to recognize the revenue by the same value. And this is the revenue of the missing unit that the customer didn't return. So I recognized revenue after 30 days of the transaction. I recognized revenue after 30 days of the transaction, because this is the fact that I have now. Still one more missing entry related to the cost of goods sold, because now you recognize revenue for 1 unit. So you need to recognize the cost of goods sold for this one additional unit. So I'm going to say debit cost of goods sold. How much? It was 1 unit times the cost per unit, which is 60. So this is the cost of goods sold. Okay, now what will be in the credit side? Clear. What will be in the credit side? Remember that initially we debited the expected returned units 180 for 3 units. Then we credited for 2 units, which is 120. So now in this account we have 1 unit for $60 as a cost, still in the debit. Still I am recognizing in my books expected returned units for 1 unit. Now this customer will not return this unit. So this 1 unit in the expected returned asset, I shall not recognize it anymore in this account. So I have to credit it in order to cancel it. So I am going to say expected credit units in the credit side. In the credit side, it will be with the same value, which is $60. So now I finished the accounting of everything. The main concept in this practical issue of the right of return is when you are going to sell a product to the customer, giving the customer the right of return, you have to recognize revenue based on the expected net collections from this transaction. I'm expected the collection of this case for 97 units. So I have to recognize revenue now on 97 units. And during the execution, during the return period, look and witness how many units the customer returned to you. And then accordingly, you will be able to adjust the estimate that you set in the beginning. Accounting under IFRS is based on some estimates, and this estimate must be reviewed periodically. And the change in the estimate must impact the period that you have the change in the estimate itself. So after 30 days, the estimate had been changed. So after 30 days, I recognized revenue based on the change in the estimate. This is one of the practical issues related to IFRS 15, related to the right of return. I hope it helps you to understand, if you have this case in your company, how should you deal with it. Some accounts need to be added in your chart of accounts, such as the refund liability and such as the expected return units from the customers, and you have to recognize revenue in the transaction date different from what we have applied before applying IFRS 15. In IFRS 15 now we have a different accounting treatment for the revenue, and I hope that the brief explanation that I have provided for the 5 steps model of IFRS 15 helping you to understand the concept of IFRS 15. Definitely there are more details under IFRS 15, and I urge every one of you to start reading about IFRS 15 and the practical issues. I hope it helps you. If you have any comments or any questions, just drop me a message and I will be able to answer you, inshallah. Thank you. Assalamu alaikum.